on this morning's Ag Issues program. A pleasure as always, albeit a couple days late this week. Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Doing fine, thanks.
Well, let's get right to it. First thing we want to talk about is the Corporate Transparency Act. This was enacted back in 2021 as part of the National Defense Authorization Act, and it contains a term that's a BOI, Beneficial Ownership Information Rules for many businesses. And the purpose of CTA was purported purpose, enhancing transparency in entity structures and ownership to combat money laundering, tax fraud, and other illicit activities. Basically, in short, anti-money laundering initiative as well. But this impacts the beneficial ownership information reporting too.
Yeah, this is something that I covered heavily at the tax schools, the K-State tax schools across Kansas last year, as well as my other tax seminars across the country, because this has application to many, many, many farming operations as well as other business entities. It's going to cover any business entity that is registered with the state. So if that's you, this applies to you. And what does it require? Well, it requires a beneficial owner to report information. Well, a beneficial owner under this provision is anybody that exercises substantial control over a covered company or owns or controls at least 25% of the ownership interest of a reporting company. And a reporting company is a company that doesn't have more than $5 million of gross revenue in a year. So the big companies are exempted. The smaller companies are covered. And a lot of people would think, well, initially that's pretty weird that they would require additional reporting from smaller businesses. But the larger businesses also have a separate reporting requirement that they've always had under the SEC rules. So they're picking up the smaller ones. And again, as you indicated in your opening comment, this is designed, at least purportedly, as an anti-money laundering provision. Now, with that said, I did warn practitioners at the tax seminars last year to go ahead and gather the information from clients, but don't file anything yet, because the filing doesn't kick in for entities that were already in existence before we got to 2024. The reporting requirement to this Department of the Treasury known as the Financial Crimes Network, or FinCEN, is that you don't have to report this information until the end of 2024. So everything's got to be in place by January 1, 2025 in terms of being filed. But don't do that, because I thought there's going to be a constitutional challenge to this, and it could be knocked out. And I was right. That has happened. There's a federal trial judge down in Alabama that ruled the Corporate Transparency Act was unconstitutional, and on various grounds. And so these reporting rules are part of the Corporate Transparency Act. But that case has now been appealed, so it is on appeal. We will see what happens. It was the National Small Business United that brought the case. That's an organization that has over 65,000 members. And the court stopped enforcement of the law with respect to the plaintiffs in the case, so for those 65,000 members only. Now, I think there's a good shot that the appellate court will stop enforcement of it in general until this is finally decided in the courts. Now whoever loses this on appeal is going to go to the U.S. Supreme Court. So I don't see that there's any way that this gets resolved by the end of 2024. But people still should be getting their information together, getting it to their CPA or preferably their attorney. CPAs really don't want to handle this, although their insurance carriers now have come out and said, we will provide malpractice coverage for you with respect to this. So you could have your tax professional, in terms of your CPA or your attorney, file this information on your behalf. Get all that information ready, but don't file it, because there's no need to give the government any information that they're not necessarily entitled to. So we'll have to know that for sure. We won't know that for sure, I should say, until the U.S. Supreme Court rules on this. Now, the court did indicate that the Congress could go back and rewrite the statute to make it constitutional, but I don't see that happening, at least not this year.
And a lot of this for a very broad perspective of it, is really the court looks like they're trying to rein in essence, unconstitutional federal power?
Yeah, the government said, well, we have the power to do this under the Commerce Clause. And the court said, well, that's true, but you didn't tie the reporting rule to any commerce. All you said was if you filed with the state, that triggers the reporting requirement, even if you didn't do any business. Well, that's not going to trip the Commerce Clause power for the federal government when you just tie the requirement to report on your existence. No, you have to actually engage in commerce for the federal government to have jurisdiction over that. And that's what the court said, that the Congress could go back and rewrite this and say, well, once you have business activity, then there's reporting requirements. But they didn't do that. That would be an easy fix. But again, I don't see the Congress doing that. Congress tends not to do anything until it absolutely has to. So I expect this to play out through the courts. If I'm right, the appellate court will agree with the trial court, and the Supreme Court will say the same thing. And then it kicks it back to Congress. But my point on this is the reporting requirements start for businesses that were already in existence before 2024. Those reporting requirements start January 1, 2025. Now, the tricky thing is if you form a new business this year, and we're not in existence previously, so you form a new business this year, you have 90 days to file your information. What are we going to do with those businesses if the rule is not enjoined with respect to everybody? That's kind of the really touchy ground right now. So if I form a new business, say April 1, I've got to file my information by July 1. Well, the courts have only enjoined this. The trial court only enjoined this with respect to the 65,000 members of the plaintiff in the case. We need clarity with respect to that. So this is a very important one. It's an important one for farmers to pay attention to, because if you don't file the information, and you're ultimately required to, there are heavy penalties for not doing so. Remember, you're dealing with the financial crimes network of the Treasury Department. So it's a branch of the Treasury like the IRS is. So this is IRS information that has to be filed. We don't want to mess around with those people.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, we talk about gross income from farming. This has to do with one of the eligibility requirements for Chapter 12 bankruptcy. Is more than 50% of an individual's net or gross income must come from farming in either the year before filing or in both the second and third tax years preceding filing as well. And the provision seeks to disqualify tax shelter and recreational farms from Chapter 12 protection. Now, this has to do with a recent case from New York involving the question of whether income from horse breeding and training counts as farm income for the purposes of Chapter 12.
Yeah, and we often get into trouble with horse operations, horse activities, and the issue is whether you're providing a service, and so you have service income rather than income from farming activities. The basic principle here for people to remember is that if it's going to be gross income from farming, that income must be tied somehow to the risk of a farming activity, risk of production, risk of price change with respect to commodities that you sell. If you're just breeding, training horses, providing riding lessons, your income is not subject to the risks of the market with respect to crop production or livestock production. And so that's usually how the courts will draw the line on this. And this recent New York case is an illustration of that. There have been cases out there in the past involving horse activities where the income from the breeding and the trading counted as farm income, but there was also crop production or there was livestock production income. And so the court said, well, this is part of your overall farming operation. But in the New York case, we didn't have that situation. These people were also repeat filers, so they had that going against them. They had tried to put a Chapter 12 plan together before, couldn't do it, did it a second time, didn't make it. The court said, no, it's not feasible. And so the third time through, the creditors objected to this. and they wanted to dismiss the case so that they could have the automatic stay lifted and go after some of the assets and foreclose on those. And their argument this time was, well, you don't qualify for Chapter 12 in the first place because you don't have sufficient farm income. And the court looked at this and said, well, that is true in this instance because your income comes from horse boarding and training and riding instruction that, by the way, they conducted, this husband and wife couple as debtors had conducted for over 50 years. And they claimed, well, our income is subject to the same inherent risks and cyclical uncertainties associated with farming operations, and so therefore we should count. But the court, again, analyzed all these prior cases on this the way I just summarized them, and said, no, you don't have any separate income from crop production, from livestock production. These aren't workhorses like we would have in the Flint Hills or out in western Kansas or the western part of the United States. These aren't ranch horses. You're providing a service, and you don't have any other source of income. And this is all service income. None of it counts as farm income. So you can't clear the 50% threshold, let alone have any farm income. So they were not eligible for Chapter 12, and the case was dismissed.
Whoops, there we go. Sorry about that. And so let me ask, Roger, with other similar activities such as dog breeding or even hauling cattle in some cases, there are some analogies with some of those similar activities?
Yeah, and it all comes down, Greg, to the same point. The courts will use this and to analyze all these cases as to whether you have service income or farm income, and that is your income dependent on some sort of production activity? Is it subject to the risk of price changes with respect to what you're producing? Or is it just merely a service that you're providing and you're charging a fee for your services? That's going to be the dividing line in all these cases. So we do see it with respect to dogs. That's a good analogy with respect to the horses, dog breeding and training. So anytime you have a service activity. We also can get into this with respect to artificial insemination. That's the true AI. When I, just as an aside, we had something at the law school several months ago, it was a little over a year ago now, where one of the professors was doing a seminar on AI. And I thought, well, that's interesting. What does he know about agriculture? And it turned out that was my first experience with the cross use of the term for artificial intelligence. I wanted to call it art-int or something like that. AI means artificial insemination. But the point is that that's a service, but if you combine that with, say, cattle production, then you probably have farm income. So anytime we've got service aspects associated with a farming activity, then we've got to be careful. If we're going to file Chapter 12, there's that threshold amount of income that must come from farming that is the key.
All right, let's go to our final topic, and of course it is something that have seen some already, but soon we'll be seeing much more, and that's prescribed burning of pastures. Of course, a very critical component of rangeland management in the Great Plains itself. But just a reminder, as always, there are plenty of rules and regulations that need to be adhered to.
Yeah, Greg, and we don't have time to deal with this in depth, but and many people are going to be familiar with it because they've done prescribed burns for many years, particularly in the Flint Hills. But Kansas does have detailed set of regulations on this. The KDHE administers these regulations, and we have to be careful that we stay within the guidelines of these rules. There are exceptions for agriculture. Agricultural burning is allowed, obviously. So open burning of vegetation and grass and woody species and crop residue and all of that is exempt from what is otherwise a general prohibition on open burning. But you've got to conduct that prescribed burn within certain guidelines, and that's where the rules come into place. And it might include that, for example, before the burn is started, that the local fire control authority that has jurisdiction in that area is notified, unless they have indicated that notification is not necessary. That's also a possibility. You can't create a traffic hazard with your burn. Now, that's an iffy thing sometimes because the wind can change direction after the fire is started. So it might have been in the right direction when you started the fire, and you do need some wind to push the fire along to keep it moving. But then it can shift and blow it over a roadway, for example. So if the wind conditions might result in smoke blowing toward a public roadway, you've got to give notice to highway patrol or a county sheriff or local traffic officials before you start your burn. Now, if it shifts and creates the problem, then you should notify the authorities at that point in time. And you can't create a visibility hazard for airplanes that might use a nearby airport. We get into that issue particularly with rural airports. So if you've got that potential problem, you have to give notice. But in all situations, make sure the burn is supervised until the fire is out, until it's extinguished. And that can be an issue also. Just take care to make sure that fire is completely extinguished. And also keep in mind that even though you're following the Kansas administrative regulations on prescribed burns, local jurisdictions can adopt more restrictive ordinances or resolutions that govern prescribed burning of farmland, of agricultural land. So you always want to check the local rules too. And we want to avoid problems with respect to burns. The rules are much more complex than what I just mentioned. From a liability standpoint, you've got a right to conduct burns. It's not a strict liability issue if someone is injured or damage occurs because of your burn. It's going to be based on negligence principles in Kansas. That much is clear with respect to the court cases. But just follow the rules and be careful. I've got a longer, detailed article that goes through all of the rules on my website.
Yep, as always. And Roger, I know it's a busy time, and you've got some things coming up this summer as well. They can all find that on the blog and on the website.
Yep, all that information, my continuing education calendar is on there. The next stop is Boise, Idaho in a couple of weeks, and then on and on from there.
All right, sounds good. Roger, as always, I very much appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.